Homeowners Protection Act. To compensate for the increased risk of borrower default when a loan-to-value ratio exceeds 80%, a lender may charge a higher interest rate or more discount points for the loan, or require that the borrower pay a premium for mortgage insurance. If the loan is to be sold to Fannie Mae and Freddie Mac, it must be insured by private mortgage insurance issued by a private mortgage insurance company. This insurance also benefits a borrower by enabling him to get financing with a smaller down payment. The insurance premium may be paid by the borrower with his monthly principal and interest payments, or the lender in the form of a higher interest rate. As the down payment decreases, the loan as a percentage of value increases. Piggyback financing. One way lenders have helped borrowers avoid the cost of mortgage insurance is through piggyback financing, which combines an 80% first loan with either a 20% second loan, or a 15% second loan and a 5% down payment, or a 10% second loan and a 10% down payment. Piggyback loans can eliminate the need for mortgage insurance, may have an interest cost lower than the mortgage insurance premium cost, and would be tax deductible regardless of the amount of a family's income. Homeowners Protection Act. As the borrower pays down his loan, the lender's risk decreases. As a result, the Homeowners Protection Act was enacted to give a borrower the right to have his PMI canceled when his equity is sufficient to eliminate the need for the insurance. The law applies to most conventional first lien residential mortgage loans obtained on or after July 29, 1999. It does not apply to VA or FHA-backed loans or second mortgages. The borrower has the right to request in writing the cancellation of the PMI when he pays down his mortgage to the point that it equals 80% of the lower of the home's purchase price or the appraised value at the time of purchase if he has a good payment history, there are no subordinate liens against his property, the property is not worth less than the original purchase price or value. If the lender does not grant the request, it must provide reasons for the denial. PMI coverage is automatically canceled once the borrower pays down his mortgage to 78% of the original value or price if his loan payments are current, or when a loan that is current reaches the midpoint of its amortization period. Notices. A lender or servicer must notify a consumer of his rights at loan closing annually and upon cancellation or termination of PMI. At loan closing, a lender must disclose when the borrower may request PMI cancellation, when PMI will be automatically terminated, any exemptions to the right to cancellation or automatic termination, a written initial amortization schedule. Annually, the mortgage loan servicer must send a written statement that discloses the right to cancel or terminate PMI, and address and telephone number to contact the loan officer to determine when PMI may be canceled. After cancellation or termination of PMI coverage, the servicer must, within 30 days, notify the borrower that PMI has been terminated and no more PMI premiums are due. Within 45 days, refund unearned premiums to the borrower. The content of these disclosures will vary based on whether the loan is designated as a high-risk loan or not. The loan has a fixed rate or variable rate. The notice given at closing for a fixed-rate loan shows an automatic termination date based on the payment schedule. For a variable rate loan, the lender provides notification when the cancellation date is reached. The PMI is borrower-paid PMI or lender-paid PMI. Lender-paid PMI requires disclosure of how it differs from borrower-paid PMI. Since the lender-paid insurance cost is included in the interest rate, it is tax-deductible, but it is not subject to borrower cancellation. Borrower-paid PMI is not tax-deductible for borrowers with income of more than $100,000, but can be canceled.